Today I'm talking about how to grow your property portfolio from 1 to 2 properties. Sounds like a small step, but it's the biggest step because you're doubling your property portfolio. The principles that I'm going to talk about today can be applied not only to somebody wanting to grow their portfolio, but for someone wanting to take that first step into either property ownership to move into or getting their first investment property. I'll go through all the steps in detail, but firstly, the thing that people need to do, step 1, is make sure that you are committed to expanding your property portfolio, and not just you, but your partner as well. The second step is to clear your personal debt. Third step, manage your credit cards. Fourth step, save money. Fifth step, get a copy of your credit file. Sixth step, maximize the rental return of your existing investment property. Seventh step, complete your tax returns. Step 8, get pre-approval for your finance. And lastly, step 9, start looking at properties and get into the market. Okay, so starting off with commitment to expand your property portfolio. It's not easy to do. In fact, research shows that 75% of Australians that are property investors only have one investment property. So it's not everyone that can do this. If you're not committed to expanding your property portfolio, you won't achieve it. Or if you do achieve growth in your portfolio, it will not last and you'll end up selling and possibly being worse off than if you'd never started this whole project. It was Malcolm Fraser who said life wasn't meant to be easy, and it is not easy to expand your property portfolio. It's like riding a bicycle uphill. Every additional property that you buy, you're increasing the gear. You're going up one gear on your bike. Okay, it's a little bit harder. You might even have to, after a few more properties, stand up to pedal because that's what it's like. So if you're not committed to doing it, or even if you're riding a tandem bicycle, you better make sure that everybody is prepared to ride hard because it is going to be a tough journey. Okay, the second step is all about personal debt. Get rid of personal debt. Personal debt is toxic to your property investment goals. Things like car loans, furniture loans, all those don't pay now, pay later plans, and credit card debt. You need to get rid of them before you start to expand your property portfolio because they are like a weight hanging around your waist and pulling you down. You won't be able to achieve good results until you first get rid of that debt. And you can start that right now. In fact, it's probably one of the best investments you'll ever make. I mean, if you're paying 22% interest on a store card and you pay money off that, it's like you are earning that 22% return. It's hard to get those sort of returns in investments. So start paying off your personal debts and make big money. Alright, step 3 is about closing credit cards. Now you're probably saying, no, I need my credit cards, don't make me close them, okay? Now, so many people easily tend to gather more and more cards over time. They don't have 1, they have 2, they have 3, or even more. You need to get rid of them. Strip yourself down to 1 card. Or even, this sounds really extreme, but if you are tight on serviceability, you could even go to no cards. Or not no cards, you can go to a debit MasterCard or something like that. Now, why am I emphasizing this point so much? Credit cards have a disproportionately negative effect on your servicing ability when you apply for finance. The ratio is something like this. For every $1,000 of credit limit that you have, it will reduce your house borrowing capacity by $5,000. So it's a 5-to-1 ratio. Okay, so let's just say you and your partner have between you maybe $15,000 of credit card limits. That is going to reduce the amount of property that you can get finance for by 5 times that, or $75,000. So it might take you from being within striking range of a $500,000 house down to looking at something around the $400,000s. It's a big difference in terms of what you can afford. So you need to get rid of those cards. You can do that at any stage. Look at them, clear the balances. Step 2, remember, was clearing the actual personal debt balances. Go for the highest rate ones first, repay them, close the card. Start on the next one, repay it, close the card. You should be able to live on one card between the two of you, or as I suggested before, close the credit cards and go to a debit card. Just remember, if you have a complete debt addiction and you can't imagine living without your Visa credit card, you can close it at the time that you apply for finance, and then after you've got the property, re-established yourself and things are financially comfortable, reapply and get a new card. Okay, step 4 in getting that additional property is saving money. This sounds really painful. Hey, savings, remember that? Yes, people used to do that after the Depression, all right? But believe it or not, it's still good financial sense to save money. In fact, you will need lots of money once you purchase the property. Not only do you have the purchase price of the property, but you have the stamp duty and settlement costs on top of that. And then once you've taken possession of that property, there are going to be out-of-pocket costs. You're probably going to have to do some minor repairs and maintenance of the property and some preparation to get that property rent ready. And those are going to come from your own dollars out of your pocket. You need to have reserves. And I have to say, it's traditional once you buy a new house that one of those appliances, a major appliance, is going to die within the first year of purchase, okay? The stove is going to blow up. The hot water system is going to start leaking profusely. And it's you as the new owner who's going to have to fund that repair. So make sure you have some spare cash that you've saved up in your account before you make that purchase. Step 5 in expanding your property portfolio is to get a copy of your credit file. You can get a free copy by ordering it online. It takes 2 weeks or so to arrive to you, or you can pay to have it delivered immediately if you want it faster. Once you get your credit file, read through it. Now, a credit file with negative references on it is going to be lethal to your ability to borrow further. So you need to take action to clear your credit file before you apply for finance. What I'm saying here is don't wait to make the loan application and then get some negative feedback from the bank. You don't want your credit issues to even come up on the bank's radar scope. Take care of them now. You can handle these yourself. If you feel you are not capable, then there are credit repair companies that specialize in this sort of work. But the things that I'm talking about is perhaps old unpaid telecommunications bills or commercial disputes where you owe someone money. Often they're very small amounts, commonly under $1,000. So repaying or clearing that minor debt is perhaps one of the best investments that you'll make in your property investment career. Identify what your credit issues are now and get rid of them so that your lender never even sees them. Step 6 is to maximize the return from your existing property. Remember, we're talking about how to go from 1 to 2 properties. When the bank does your lending assessment, they're going to look at how much rent you're generating from that property. So the idea is have your property maximizing its rental return now before it hits that lender's desk. So what can you do? Firstly, review that rent, okay? Perhaps it hasn't been increased for a while. Maybe you've got a fixed term lease about to expire and you have an opportunity to review that. Then get that increase in place now and document it before you make application for finance. Now you might be saying to yourself, Adam, I can't just increase the rent. Well, then I'd say, how about taking a look at your property and maybe make some improvements to it or fix some nagging repair issues that annoy the tenants, get everything good, get your tenants happy, then increase the rent. That's what you want to do. And when you increase the rent, try and get it onto a 12-month lease. Some banks tend to look at residential property a little bit like commercial in that they want to know that your tenant is going to be sticking around for a while. So get a 12-month lease in preference to a periodic or 6-month lease before you make application for finance. Step 7 is all about completing your tax returns. When you apply for finance for your next property, you are going to need your most up-to-date tax information for the lender. They'll be asking for it immediately. So do the legwork beforehand. Dig out your receipts, dig out your payment summaries, go to your accountant and prepare your documentation. if you're a small business person, definitely get your financials completed before you apply for finance. You will need that notice of assessment back from the tax office before you go to the lender. Another reason it's really important to get all this documentation done is so that you get the best interest rate, which has a big impact on cash flow. If you can't substantiate the income that you're claiming, you may be forced to use low documentation lending, and in that case you'll pay a penalty of between 0.5% and 1% on top of the normal interest rates. So do the legwork, prepare your financials, and you'll be rewarded with the best finance deal, which assists with the cash flow for your property. Step 8 involves getting pre-approval for your finance. It's important to get your finance in order before you make an offer for a couple of reasons. The first one is when you actually approach a bank, it'll flush out any remaining credit issues that might be outstanding for you, whether there's something on your credit file or whether perhaps there is a blockage, which might be in terms of your income or even in terms of the property that you're offering for security. So apply for pre-approval now and bring those issues out into the open. Then you can work on them before you find a property that you actually need to buy. Second reason is to give you an idea of how much you can actually get borrowing for, because that will determine your purchase price. Your borrowing limit that the bank will pre-approve you for, plus what your savings are, gives you an idea of what you can buy, which then you can narrow down your focus. So, I mean, it's no good looking at $500,000 or $600,000 houses if you can only get finance for $350,000. So have a look at what that borrowing limit is from the bank, and then see what that can get you in terms of your housing dollar, and then customize your plan, whether it's houses or units, whether it's high end or low end. But work out beforehand so that you don't waste any time when you're actually looking. When you're looking for finance, just remember that each lending bank or financial institution has a different credit criteria between the institutions, and even within the same bank over time the credit policies change. That's why I suggest probably use a finance broker and get them to have a look at a range of banks and other lenders to see who has the best offer to fit your situation at this point in time. Step 9, actually start looking at properties. So you've fixed up your finance, you're both committed to this process of expanding your portfolio, you have the pre-approval, now start looking. And if I can take a step back to that pre-approval, if it turns out that you have the borrowing capacity for say $700,000 worth of property, that doesn't mean that you have to look at $700,000 properties. It's a limit, it's not necessarily a target, okay? You may even think $700,000, we might even look at $350,000 properties. But even if you're not looking at two, I would say step it back from that maximum limit. Don't stretch yourself out. Allow yourself some room for reserves. But then get in the marketplace and start looking. When you're looking, narrow it down over time to a small range of suburbs, and then once you get comfortable with the suburbs, to a small range of properties. What you're trying to do is build some expert knowledge so that you are the one who knows the most about the market value of, for example, 3-bedroom, 1-bathroom houses in Lockridge. And then you are having knowledge and power which will greatly assist you in the negotiation process. So get out there, visit the home opens, and develop an appreciation for what is good value and what is not, and then you can start looking at making offers. Looking at all the steps together, I think the theme is consistently about preparation. Do the homework, make the extra effort to get your house in order before you expand your portfolio. And the other component is, of course, that very first step of obtaining commitment, both of yourself, of your partner, and even your whole family, to making that additional step. Because if you do all this work, but then don't have the support of other people, you won't be able to bring it through to completion. So make sure everybody's on board as you expand your property portfolio.